Welcome, everyone. Happy President's Day. No mail. The banks and stock markets were closed, but most people still had to work, unless you work at a school, a bank, or a stock market. Anyhow, this is the Fiscal and Economic Issues Discussion Group's February meeting. Generally speaking, we've got some good news to report this month, and let's get started. What do we do? Here to help you understand the facts.
Hey, Pam, we're on.
And get the real facts so you can share them with your friends, and in tweets and blog posts and comments about articles you read and stuff like that. Tonight's presentation is following a normal order of labor market statistics, federal budget, economic statistics, including inflation we'll discuss there, the year one review, MMT or modern monetary theory, sector balances. So let's get started on the labor market. There was a lot of apprehension about what the jobs report was going to look like for January, because a couple of days before the Bureau of Labor Statistics reported, ADP reported that we'd lost 300,000 jobs. But surprising a lot of people, the Bureau of Labor Statistics, or BLS, reported that jobs were up 467,000 in January versus the prior month as restated, actually up 678,000 versus how December was initially reported. There was a lot of seasonal adjusting that went on to prior months that brought November and December higher, but some of the months in the middle of the year lower. About 2.9 million jobs below our February 2020 jobs peak. Remember that we lost 22 million jobs as reported in March and April of 2020. So we're about 87% of the jobs are recovered. And at the current rate of job growth since Biden took office, or at the average in 2021, we should get to full recovery by July, August of this year. So that's a goal. It would be nice to be fully recovered before the midterm elections. This graphically shows the revisions to the numbers. I was going to say, these aren't as initially reported. This is as reported just prior to the January report, so the December report, and then how these numbers were adjusted. So you see, like, the December number and the November number shot way up, and the January number from last year shot way up, but some of the numbers in the middle of the year shot way down. And a lot of it is seasonality. These are seasonal adjustments to try and take into account that we hire for Christmas, we lay people off after Christmas, hiring goes up, as students become available in the summer, and goes down when they go back to school. But COVID has really messed that up a lot. And so, the last year, 2 years ago, there wasn't a lot of seasonal hiring in the summer. So last year, the seasonal adjustments didn't bring the numbers down. And so we had really high seasonally adjusted numbers for June and July. And now they're saying that we're going to go back and bring them down. It's, the seasonal adjustments make sense. And with or without the seasonal adjustments, we gained over 6 million jobs in the 12 months since President Biden took office. So it's been a great period of time for job growth. The seasonal adjustments just change a little bit of which months get jobs and which months don't. And this is a chart that shows what was in the graph, that January, February, November, December numbers went up. Middle of the year, May, June, July went down versus the prior, And on a net basis, we showed 211,000 more jobs last year than we had previously. And that's not so much the seasonal adjustments as the fact that every month the numbers are reported provisionally and are subject to adjustments for the next 2 months. And then subject to adjustments later for other reasons, like when the unemployment insurance tax forms get filed, and we get a real count of how many people or companies are claiming they have on their payroll. Unemployment rate, and the U3 rate, which is what's normally reported at the most, actually went up slightly from 3.9% in December to 4% in January. But as we'll go into it in a couple of more slides, it went up for really good reasons. To be in the U3 unemployment rate, you have to have not been working, period. And you have to have actively looked for work in the prior month or 4 weeks. 4 weeks, not a month. The U6 rate is higher because it includes people who weren't working, who actively looked for work anytime in the prior 12 months. And it also includes people who work part-time but want full-time employment, which is another 4 or 5 million people. So the U6 rate is always going to be higher than the U3 rate, but it continued to go down. And now a 4% unemployment rate is pretty darn good. Historically, since we started keeping the statistics, it would be in the 84th percentile of months that have been reported. So good number. You know, I can recall when we thought the full employment rate was going to be 5 or 6%. So this, 4% is pretty darn good. But when I talked about why did it go up for a good reason, we had 1.4 million people on a seasonally adjusted basis come back into the labor force in January. And of those, 1.2 million reported that they were employed. So this is a different survey than the payroll jobs. This is the household survey, but it's, this is a huge number of people to report that they gained employment. They're now employed. They weren't employed the month before. They're now employed. But the difference between those two meant that the number of unemployed went up by about 200,000. So the unemployment rate went up from 3.9% to 4%. Where the unemployment rate is the number of unemployed divided by the civilian labor force. And this is a comparison of the payroll jobs in blue and the household survey people who set gains and people who said they were employed in red, according to my graphic, and I don't know what color you're seeing it as. But you see it varies a lot month to month, but over the year, over 13 months, you're looking at jobs going up 7.1 million versus the number of people employed going up 7.3 million. And for 12 months, jobs went up 6.6 million, which is, since Biden took office, versus 7.2 million on the employed. So great numbers. What's the right number for January? I don't care because I don't like to focus a lot on a single month, but I'll focus on the 12 months and go, that's darn good. Employment to population ratio 25 to 54 is something that we look at. Prime working age 25 to 54 is an attempt to exclude most students and most retirees. And the employed to population says what percentage of these people are employed. Prior to the pandemic, about 80.5% of people in this age group were employed. Now we went down below 70%. We're now back up almost 80%, 79.1%, well, 1.4% lower, which is about 1.8 million people. So we're short about 1.8 million people versus the pre-crisis peak. And if you remember from earlier in the graphic, earlier in the presentation, we're short about 2.9 million payroll jobs. So the bulk of the shortage is in this age group. And I haven't really seen anything. I've seen a lot of things that try and estimate why. A lot of it has to do with childcare and COVID. But we'll see. We also tend to have senior citizens who lost jobs who have not come back into the workforce. Anyhow, the Bureau of Labor Statistics gave some information about the pandemic, which they've been doing since a couple of months after the pandemic started. The significant one here is that for January, 6 million people reported they'd been unable to work because their employer closed or lost business due to the pandemic. And so this was up about 3 million versus the prior month. The others didn't really change that much. And a lot of it has, I think, to do with the Omicron variant peaking during this reporting period. As Omicron is now coming down, hopefully that means that we'll be able to get more people back to work, because more people back to work, as we'll talk later, raises tax revenues and cuts down on government spending. So how does this recession compare to other ones? This recession, much greater loss of jobs, but recovering for the number of jobs lost fairly quickly. This is the Great Recession, where we lost jobs from February of 2008 to February of 2010. And then we didn't get back to more jobs than before the recession until May of 2014. So way the heck out here was May of 2014. It looks like we're going to get there right around 30, 31, 32 months. We'll have fully recovered all the jobs lost in the recent recession and be back up into growth, more jobs than ever before. If there's questions about any of this, comments, whatever, please feel free to interrupt me. I'm trying to follow the chat, but don't always do a great job. So let's go on to, okay, Sunny, looks like you had a question about U3 and U6. Did I answer it, or do you want more information?
I just didn't follow what the U3 versus U6, what it was referring to. It's
okay.
like, thanks.
Well, U3 is the unemployment rate that we normally hear reported every month. And that's the one that went from 3.9% to 4%. And again, to be counted as unemployed in the U3 rate, you have to be unemployed as if not worked any hours. 1 hour would not qualify you to be unemployed. You also have to have actively looked for work in the prior 4 weeks. Somewhat stringent test, but that's what the U3 rate is. Does that make sense?
Yes, it does. Thank you.
Okay, the U6 rate is a much broader rate of unemployment. And we won't get into what the U1, U2, U4, and U5 are. But anyhow, because they do report those every month too, just to keep us all on our toes. But the U6 rate says, all right, we've got people who weren't working, who would like a job, but they haven't they didn't actively look for work in the last month, but they looked for work at some point in the last year. We're going to go ahead and count them as unemployed in the U6 rate. And we've got some people, we talked about how 1 hour of employment would count you as a part-time employee and not be part of the U3 unemployment calculation. But if you wanted more hours than that 1 or 2 or 10 or 20, and you wanted full-time employment, the U6 rate would count you as unemployed underemployed for purposes of the U6 unemployment rate. So it's people working part-time who want full-time employment.
So where does this come from, this data? I don't want to hijack the
No,
presentation.
that's okay. Every month, the Bureau of Labor Statistics and the Census Bureau, and I'm not sure who else is involved, call up 60,000 households.
Oh, okay,
And so it's a household survey.
okay.
And there's, you can look on the BLS website and they'll tell you that of those 60,000, I think there's 20 or 40,000 that repeat month to month. And so they rotate them on and off. So you have some overlap month to month between the surveys, but it's some of the same people, some different people every month.
Okay, thanks. Let's move on.
Okay.
Appreciate it.
Economic statistics. Budget deficit, nice graphic. Thank you, David. The fiscal years run from federal fiscal years are not calendar years. So our budget years start October 1st, they run to September 30th. Trump budgeted the fiscal years 2018 to 2021. Biden is budgeting fiscal year 2022 to 2025. So the Biden's American Rescue, this was a chart that the CBO did last summer, I believe. And David may have adjusted the 2021 fiscal year 2021 number, or has CBO come out with a new chart? In any case, I think this is the last summer and David adjusted the 2021 number. It includes the American Rescue Plan, which was passed last March. It does not include the infrastructure bill that was passed this fall. On the other hand, that's not a huge number. It's expected to add about $250 billion to the deficit, or $25 billion per year. And if you look, we were in a $2.8 trillion deficit last fiscal year. We're looking at a $1.2 trillion deficit this year. So 25 billion, while it's a big number to you and me, in federal budgeting terms is not a big number. Build Back Better is not included in this. It has not passed. And so what we're expecting to see is that the budget deficit to drop in the current fiscal year and for a couple of fiscal years after that, and start to go back up. And then longer term go back up because the population's aging and we have therefore increases in spending in Social Security, Medicare, and Medicaid. And just as a reminder, Medicaid, a big part of the increase in Medicaid spending is paying for nursing homes for senior citizens that have exhausted all their resources. Now, this is from last summer, so 2021 fiscal year was actually an estimate. The $3 trillion projected deficit actually came in at 2.8 trillion. And then these are the forecasts for the Biden years. And what we see is that spending is expected to go down about 1.3 trillion this year, and the budget deficit is expected to go down about 1.6 trillion this fiscal year. So Biden's first fiscal year, we're going to see a big drop in spending and a big drop in the deficit. I wish somebody could convince Joe Manchin of this when he talks about how we need to cut the deficit, but that's just me. But anyhow, we have already cut the deficit substantially in the current plans. We'll ignore the fact that Republicans keep talking about the big spending Democrats, regardless of the fact that just like typically spending goes down under this Democrat. GDP recovers faster than jobs. It happened in the Great Recession. GDP we recovered by 2011, jobs we recovered by May of 2014. So 3 years later. And we're seeing some of this a year later. We reached a pre-crisis peak on GDP in the second quarter of last year, and we expect to get to peak jobs in either the second or third quarter of the current year. So faster recovery on both jobs and GDP. A big factor in the fourth quarter was inventory buildup, and we'll see what happens with these things as they go forward. Interestingly, government spending went down in the fourth quarter. So government spending was subtracted, the reduction in government spending subtracted from GDP growth in the fourth quarter. And as we've talked about before, recovery has been much faster in goods than in services. People are buying stuff. They're not going out to as many bars, restaurants, and movie theaters before. Although goods have come down a little bit and services are going up, if those trends continue, I guess it depends when do people feel comfortable dining indoors in restaurants in the winter here in Chicago. And if everyone's fully vaccinated, I actually don't feel too bad about that. But I'm probably not going to go into a movie theater in the next couple of months until things get a little bit more controlled than they are. That's just a personal thing, and everyone's making their own decisions about that. So we have big demand for physical goods. Supply has not caught up, which is it contributed to raising prices. This is monthly core inflation, so it does not include the more volatile food and energy prices. And we see that core inflation was pretty low in the summer and then went back up for the last few months. And this translates to core inflation year over year going up 6%, where if we include food and energy, all items are up 7.5%. And we can see that graphically again in this graph. And the big drivers are energy prices. Gas is up 40% year over year, January versus the prior January. And the price of used cars and trucks are up 40%. Those are the big drivers. And another big driver is shelter, which is interesting because it looked like it was only up about 4%, but it's a bigger part of the overall people's spending. Shelter is about 30% of one's expenses. And we're seeing a lot of increases both in price to buy a house as well as rental costs in many markets, going up 10% a year or more in some markets. Where some things, inflation is relatively low year over year. Education, recreation, apparel, medical services, all those are pretty small. Just another way to look at it, energy, pandemic affected services, and vehicle, and those new and used car prices and the price of car rentals are still pretty darn high. I'm waiting for those rental car prices to drop again so I can travel economically. I may have to wait a while. And if we look at since Biden's inauguration, inflation has gone up a little faster than wages. So workers have lost about 0.6%, although, and David, my recollection is that lower earning workers, their wages have gone up faster than middle or higher earning wages, but I don't have the data to back that up.
That's correct, but I recall seeing stuff like that over the past few quarters. I haven't seen the last couple of months of that, but it's been the trend in the last year or so, at least.
Okay. But if we look at since the beginning of the pandemic, what we see is that hourly wages, what happened is lower income people got laid off. And so average hourly wages went up substantially. And then they came down and then they've been going up. And inflation came down and it's been going up. And what we see is that wages have grown faster than inflation over 2 years. And we had a lot of support for people when they weren't working, $600, $1,200 checks, an extra $300, $600 a month in unemployment benefits. So we supported people during the downturn. Arguably, the Trump and Biden support efforts may have provided a little bit too much support, which is why we're seeing people buying lots of goods and inflation currently. But I much prefer to have a little inflation versus the alternative, which is we didn't provide enough support and we had people, getting evicted, not being able to afford food and things like that, which would have hurt GDP growth, among other things. So I think, overall they made if you're going to it was better to err on the side of a little too much support than a little bit too little. I fear that we may be getting into trying to take down inflation too fast, but I think that's a later part of this discussion. And
I can
here's
mention this one. Yeah.
Yeah, go ahead.
I mean, what the Fed did, San Francisco Fed did a study on this. If the prices of things moved a lot very early on in the crisis, so they were saying between February and April of 2020, then, and let me start my video here. See my smiling face somewhere. The Fed did this study and they said, all right, what prices moved right away when the crisis hit? So this is February and April of 2020. And they called those the sensitive things. And then the other areas that didn't move, they called them insensitive. And when they look at that number, it's almost all COVID related stuff that was driving this. So goods and services, both. I think to some extent, it seems odd that with energy and car prices driving this, which you would think would be, I guess energy would say is COVID sensitive because people expected a big drop off in demand. So energy prices would have fallen right away. The cars is a little weird. I doubt that one. I don't know if that one was in the sensitive bucket or not. Maybe it was, but they're just saying that stuff that's sensitive to a pandemic is where the inflation is coming from. And to very great extent, you can see the blue line is almost all of the inflation is there.
Yeah. Well, gas and crude oil prices went down early in the pandemic because on March 16th, President Trump told us all to stay home to try and stop the spread of the virus. He finally recognized it was significant. And, people, limit your trips to the grocery store, get deliveries, don't drive, don't go anywhere. And during this period, I think there were a couple of days where the worldwide price of crude oil was actually negative because we didn't have places to store it. It was being produced faster than it was being consumed. So if they looked at it in terms of what appeared to be affected by the pandemic, then gas would be in the blue bars, even though it was indirectly affected.
That makes sense. Yep.
And now people, myself included, are looking at, two things. If I go to Arizona this spring, I'm probably going to drive. A lesser reason is that I think it's going to be safer to drive than to go ahead and fly. Not that the flight itself is exposing me too much, but getting to the airport, getting through the airport. But the bigger factor is the price of rental cars is just too dang high. I mean, I got spoiled the last 2 years when I went down to Phoenix and got 2-week rental cars for under $300 total. And now I can't find it under $1,000.
I mean, one of the things about this is the narrative that we're hearing, or that Republicans would like to pin on this, is that because of Biden's Relief Act, which no Republicans supported, as you'll remember, that's what's driving inflation. And when you see something like this, you see that there's it's not likely to be stimulus that drove this. It's something else. And we'll also show you in a little bit that Europe is also having inflation, which it's unlikely that our stimulus here caused their inflation. Yeah. So there's certainly an argument that it may have contributed a little bit, but when you see a study like this, you should be very skeptical about the idea that Biden's stimulus, the Relief Act, drove a lot of inflation when Europe's got it. Energy prices are a very big part of it. I can't imagine that. When I looked at a study a couple months back that showed what people were doing with the money they got, it was not buying a new car. So you got to be skeptical of this idea that and again, cars are what's a big part of the inflation, what's driving the inflation, as Carl pointed out earlier. They didn't just get their stimulus check and then go running to the car dealership. That's not how people operate, especially people that live check to check. They pay their bills, they pay their credit cards, they do other things. So be very skeptical of the idea that blaming the Relief Act is where the inflation comes from, because it's global. And you can see this study showed that it's sensitive stuff. And it also, Carl showed earlier, energy and vehicles. The energy prices are determined globally for the most part, and vehicles is not something that people are just going to run out and buy because they got a $1,400 check.
Well, it's also, vehicles, a big reason the supply of vehicles is small and smaller than the car manufacturer would like is because of the worldwide shortage of computer chips for cars. But to echo your point, if you look at the producer price index, which is kind of a leading indicator of the consumer price index, the biggest month increase in producer prices on a percentage basis was January of 2021, which was Trump's last month in office. It went up 1.2%. Producer prices went up 1.2% in January of 2021. So they were definitely, prices were heading up before Trump left office. We just didn't see it in the consumer prices until later. And we'll let you deal with this one, which is basically expectations of inflation.
Right. Yeah, this is just what investors think is going to happen with inflation. And Paul Krugman pointed out that when you see a blue line like this below the red line, meaning the 10-year rate is lower, that means that people are not expecting this to spiral out of control, that they figure the Fed or the government are going to get this under control. And note also that sort of in that November time period, that's where you see that 2021-11, you see that's where it peaked. It's been coming down and sort of moving sideways, which is what the Fed wants. If this thing was still going up like you see in that September to November timeframe toward that peak, if that was still going on, you'd probably see the Fed talking about much larger interest rate hikes than they're currently talking about. They keep hinting that they might go 0.5 percentage point. They use the term basis points, which a basis point is 1/100%. So 25 basis points is 0.25% increase in the interest rate. 50 basis points is 1/2. There's some talk back and forth about maybe they'll do a 50 basis point, 0.5% increase in March. We'll see. But if this doesn't look like they need to do that. The inflation expectations are sort of moving sideways and not up right now.
The big fear, just like did we provide too much support for the economy? Is the Fed going to take too much, action to tamp down inflation and cause another recession? Because the last time the Fed took big steps to tamp down inflation at the end of the 70s, beginning of the 80s, for those of us who are a little older, we remember the recession, the relatively brief recession in 1980, and the more extensive, deeper recession of 81, 82. I really don't want to relive those periods of time when unemployment rate went up to 10.8% and continued to be high for a period of time. It wasn't the best time to be graduating college and looking for your first job. So again, this is more looking at 1 year and 3 year expectations for inflation.
Yeah, and this one is individuals. They were polling people and not looking at what the investors were probably doing based on the bond market evidence. This is just polling of people, what they expect, and it also tells a pretty similar story that they figure we'll have inflation in the short run, but not in the longer run.
Yeah.
Short and very, I guess short and medium, short and a little less short, 1 and 3 year.
Well, it's kind of like the economists use the term transitory, which to them meant 1 to 2 years, less than 2 or 3 years. It wasn't going to be the consistent inflation that we had back in the late 70s, early 80s, where we had inflation over 5% for I don't know how many years in a row. I'd have to go back and look. Transitory meant that, but it didn't mean, it's going to go away in 2 months. And this is where you were talking about the fact that inflation is not unique to the United States. Other places in the world have inflation too. The Euro area is up 5%. And energy is a big part of their inflation as well. They're apparently not being driven quite as much by used car prices. And a year earlier, inflation in Europe was negative, and we can see 12-month inflation for various countries. Looks like these are all in Europe, with Estonia and Lithuania leading the way in inflation, and Malta and Portugal having the lowest inflation. Is Ukraine not part of Europe? I don't know the answer to that. I was just thinking, since it's
That's a good one. It's not in the EU. I think this is the, what is it, the EU 30 or what it's called? So
okay.
I guess not. Yeah.
So it's
the
not
answer to your question, maybe not much longer.
Well, that's
So I
true.
knew somebody was going to say that. Somebody had to say it.
But I think you're right. This is more of an EU definition of Europe as opposed to a geography instructor's definition of Europe. And this is what I was talking about the producer price index. That if you look at the last 13 months, the biggest increase in the producer price index was in Trump's last month. It had gone down for a while. It jumped back up in January. Is that an anomaly, the start of a trend? I think it may just be a function of gas prices, but we'll see. Oil production was slashed in 2020 when everyone stopped driving. I remember that's when Bill started his morning coffee and conversation, and we talked about, gas mileage. And I joked, in terms of how many weeks per gallon I was getting. My car just didn't go very far at all. It was filling it up maybe once a month, maybe every other month. Oil production
There's
is
a few.
back, but not where it was pre-pandemic.
Yeah, I was seeing there was some interesting back and forth on Twitter. One of the lines of attack against Biden is that, because he canceled or stopped the Keystone Pipeline, did a couple of other executive orders, that he's somehow sabotaging U.S. energy independence, and we're much more dependent on Russia or other countries now for fuel than we were in the past. There's been some kind of misinformation campaign going on because I'm seeing a lot on Twitter. And this, when you look at, first of all, you can see the big drop off in 2020, which was under Trump, and you can see that it's taking time to get those producers back, but they have a lot of encouragement to do so because oil prices are way up, and so they will get there. But the definition of U.S. energy independence, the way it's commonly used is our exports of oil and other kinds of petroleum products is greater than our imports. Our exports are greater than our imports. And so if you look at that table in the lower right, during 2020, that top line, total all countries, we exported more than we imported. So we were, by that definition, energy independent, even in 2020, because our consumption dropped off too. And so we wound up being by this definition of energy independence, exports bigger than imports, I believe the first time we got there was in 2019. And then we stayed with it in 2020. The concern was that we would have lost that energy independence, but the data, I think it just came out like today or yesterday, said that it's essentially even. The imports and the exports are almost identical across all of the types of products. It's different, like some of the ones that are non-oil and oil, I forget exactly where they are, but when you net them all out, we're basically still energy independent by that term. Understand that we still trade a lot with Canada with oil and other petroleum products. We get stuff from a lot of different countries. The headline here, I think, for one of the headlines on where is it? Is it on here? Maybe not. It's like 90 countries or 80 countries that we are importing and exporting with. And so there's always some of that. So the idea that we're importing more from Russia as if we never were before, I mean, just be very skeptical of that. The top 5 countries are listed here, and Russia's been even in 2020, before this crisis hit, was still in that top list. But you can see Canada is the vast majority of it in the lower right, that under top 5 countries, Canada, 52% of our imports are from there. So the other one's not so much. So just keep this in mind of people that are saying Biden destroyed our energy independence, blah, 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 by the same definition we were using under Trump, exports greater than imports, we're still energy independent. So don't let that piece of misinformation slip past you, or just be aware that somebody out there is pushing that narrative on the conservative side, and it's just not true.
Yeah. I saw slightly different data because it didn't show energy independence in 2019. Did show it in 2020, but it showed it in 2020 because our demand for oil dropped. Our production dropped in 2020, but our demand dropped by more, which is how we got energy independent.
Yep, that's a good point.
It wasn't that we increased our production under Trump. Demand dropped more than production dropped.
Yeah, and again, this big 2020 drop, that's not Biden, that's Trump.
And well, and some of the drop between 2020 and 2021 may actually be, since these are annual numbers, may have actually been under Trump as well. But again, if you remember what I said about a half hour ago about how briefly in 2020, I forget, it was April, May, June, somewhere in there, the spot price for a barrel of oil actually went negative because we couldn't store it anywhere for a day or two. There's a reason that oil producers cut back production. If you could produce it and then have to sell it at a negative cost, that stinks. Okay, trade deficit. Not surprisingly, with everything we're buying on the good side with our GDP increase, our trade deficit has gone up. Now, but it's important to note that while our imports have gone up, this is $500 billion or so, a little bit more than that, our exports have actually gone up as well, about 400 billion. But so our exports have gone up, but our imports have gone up by more.
Yeah, when you hear that our ports are clogged, you can look at that import number for goods, and you can see that it's in that row under the goods BOP basis. But from 2350 imports, 2.3 trillion, almost 2.4 trillion, up to 2.85, 2.9. You've got $500 billion more goods coming through our ports. And the ports are affected by the pandemic too, in terms of their people getting sick or other things. So you're jamming another 21%, you can see there, 21% more in imports came in 2021 than 2020. That is not easy for them to handle. Clearly, they're not going to, they staffed down a little bit in 2020, and now it goes back up. But there's a statistic earlier on where the port volume is like, it's like 20% more goods are being, it's not the port volume. The consumers are about 20% up. By one measure in the GDP statistic, it's up like 15% for goods. The ports are doing record volumes. They're just not able to keep up with all this stuff, which is why you hear these stories of ships that are filled with goods sitting there and queued up, and ports being jammed with stuff. I mean, people have been importing like crazy.
Yeah.
This is a record dollar trade deficit, by the way. It's not a record in terms of the size of the economy. We hit that during the before the Great Recession, like 2006, I think. I have the stat here somewhere, but where is it? Yeah, it hit 6% of GDP in 2006. That was the housing boom. People were borrowing incredible amounts of money to buy housing, and we were borrowing like crazy from overseas to inflate that bubble. They were lending to us. We were saying, hey, take all these investment-backed securities. We're happy to give that to you in exchange for money so we can buy your stuff. It was sort of vendor financing. And that's why the trade deficit got crazy back then. It wasn't because we were importing all kinds I'll stop there. The trade deficit is record size dollars, but not record size relative to the size of the economy.
Okay, so economic forecast as of 2 months ago. This was before calendar year 2021 GDP was reported at 5.7%. The projection had gone down from 5.9 to 5.5%. We're still looking at 4%, or we were looking at 4% as for this year as of December, and then going down closer to 2% in the long run, around 2% or a little bit below 2%, which is the long run we were running for a while. Unemployment rate, we thought we'd get down to 4.3%. We actually, when they reported December, we were at 3.9. We're now at 4%. So good unemployment rate, and their long run inflation for the year on the PCE level. I don't know if I've seen the PCE level for the year, but it's probably a little above the 5.3. But again, they're not expecting it to last very long at that level. If this holds and inflation comes down by the middle of this year, I think then pretty much all the economic indicators are going to be good, as long as it doesn't come down because the Fed crashes the economy and puts us into another recession.
And if you look at that federal funds rate down at the bottom where it says 0.9 in 2022, that would be roughly quarter point increases about every quarter. I think we're up to 0 to a quarter now. So then it goes to 0.5, 0.7, 0.5, 1. So I guess they're looking at almost like, is that right, Carl? It would be 3 interest rate hikes of a quarter point if they're to get from where we are now to 0.9, approximately.
Pretty close,
to 1.
yeah. I mean,
so not 4, but 3 raises.
Yeah, that would adding 0.75 to the 0.1 gets you to 0.85 or not quite 0.9. So yeah, I mean,
Yep.
But some people are talking like we need to really the Fed needs to take aggressive action to eliminate inflation quickly so that we can crash the economy before the midterm elections and vote out the Dems. I'm sorry,
let's hope they don't. Yeah, that is, it seems like there's our reliable conservatives are all for raising the interest rates fast. And if you're following any of the major Republican entities on Twitter, you're seeing nothing but talk about inflation. It's all about inflation, and they don't talk as much about what the Fed should do about it, but if they want to remind people of how much pain they're feeling from inflation, and I don't blame them. I mean, I'm sure if the situation were reversed, we might be doing the same, but it's still there are part of what you're learning here are the counter arguments to that, which is if you take away inflation, the rest of the economy is doing darn well, and wages are keeping up. So we don't want the Fed to go overboard here. And keep in mind, the Fed is doing something else that's very important, a little more complicated than interest rate hikes, but they are slowing down to their bond buying. They were buying I forget the amounts, but they were buying a certain amount of bonds every month and growing their balance sheet, meaning they were stimulating the economy. Now they're slowing that down. And I don't remember, Carl, you might know this. Are they planning to shrink the balance sheet or simply stop it from growing? I forget where they ended up.
Well, ultimately, at some point they plan to shrink it, but I don't remember whether that was, in the near term or sometime in 2023 or 2024. So yeah. I honestly don't recall.
One way to think about that is they are slowly taking their foot off the gas pedal. They are not putting the brake on, so to speak, and really slamming it from a bond buying perspective. They are buying less, but they are still buying. Yeah. I believe they were going to go to neutral, meaning they were going to keep the balance sheet at a certain size, and as bonds come due, they swap them out and buy more to offset it. But I would think of it as the brake goes on when you see that balance sheet size start sinking. And so we'll see what happens. They have a variety of things that they can do. The interest rate is only one of them. And that's the one that's the easiest to explain and is the most visible, because as soon as you move that rate, you tend to see the mortgage rates move, credit card amounts move. I mean, the interest rate is it's not a scalpel, it's their blunt instrument for moving things in the economy.
Yeah. So again, if they raise the interest rates a quarter point in March, I think the economy will survive it. It'll be, it'll slow down. But the other thing to remember is that as we talked about a few slides back, federal budget deficit is being cut way back. So the fiscal stimulus side is going down by over $1.5 trillion this year. And so it's not just the Fed is taking their foot off the gas, but Washington and Congress and the president are taking their foot off the gas as well.
And that seems to be a very carefully guarded secret. Like, Carl, I think you and I talk more about deficit reduction than anybody else. Like, I have not seen any major, I see rarely as any major media talking about the fact that the budget deficit is getting cut this much. And way back in 2012, when the Bush tax cuts were coming up for expiration in the start of 2013, there was nothing but news about the fiscal cliff. The fiscal cliff being this bad thing that would happen if you suddenly cut the deficit like crazy by letting the Bush tax cuts expire. The conservatives were speaking up saying, whoa, you can't cut the deficit this fast, because they were worried about the Bush tax cuts being allowed to expire at all levels. And as you'll recall, Obama let them expire for the richest people, not for everybody else. So he preserved about 80% of the dollar value of the Bush tax cuts. And that crisis, the so-called fiscal cliff crisis, was averted. He sort of split the difference. But right now, we've got a fiscal cliff that's twice that size, at least. I think as the size of the economy, it's like 3 times as big in terms of dollars, and nobody is talking about the fiscal cliff because Republicans are more than happy to see the deficit getting cut this way, because it's going to slow down the economy. They were worried about the tax side of it before, is how I would look at it. Yeah, no talk of a fiscal cliff right now. No talk of how awesome it is the Democrats are cutting the budget by 60%, budget deficit by 60%, and the Democrats aren't talking about it very much either. Even Joe Manchin, who's saying he's worried about spending, at no point is he saying we're already cutting the deficit by 60%, but I want to make sure we cut it more. I mean, it's very strange right now that the deficit has become a non-entity in the discussion.
My comment would be, I don't think Manchin knows. Well,
we got to send him this chart, Carl. We'll be like, hey, we'll send it. We'll make it pretty and send it to him. We'll frame it and send it to him.
We'll send him some other charts, whatever. I mean, I laugh every fall in October, but cry and cringe. How seldom, because again, the fiscal years end on September 30th. So the budget deficit for the actual budget deficit fiscal year is announced sometime between the middle and end of October. And it is highly unusual for any media to report on the budget deficit and to spend any time on it at all. Many years, I've searched the Chicago Tribune online edition to see if they ever mentioned it at all. And in many years, they never did. They talked about forecasts, but the actual budget deficits never came into play. This is Goldman predicting that instead of going up to 0.9% for the rate, the Fed will hike rates up to 2%, which is a great way to tamp down the economy and get a recession before the midterm elections. I hope the Goldman forecast doesn't come true. You have any comments on this one?
Nope, go ahead. Yeah, let's break here.
Sounds like a good plan.
Yeah, we'll do the Biden one-year review and then go into some MMT-related topic, the sector balances, which is one of the most fascinating concepts in economics, I think. And so let's take, what do you want to do, Carl? Where are we here exactly? 8:06. We want to come back at 8:15?
15.
In fairness to Mr. Manchin, doesn't he live and represent a otherwise predominantly Republican district, sort of like Melissa Bean did? And we remember how Melissa Bean had to pretend to not do the things that were wanted of her by her party, and instead had to pretend to be a little bit more moderate or conservative or whatever to try to keep so she could get reelected. Ultimately, she didn't do it successfully enough, and she's no longer serving. And would you want the same for him?
Well, but I think that if your voters want a big cut in the budget deficits, you'd actually go ahead and tell your voters that we've made a big cut in the budget deficits. You wouldn't keep it a secret.
But you've got to convince them of the whole story including things contrary to what they're being told by lots of other sources that they trust and believe.
Yeah, well, that's a problem.
Yeah.
All right, I'm gonna go break. I'll be back.